Kaleel Barton, your Lifetime Realtor, and we're back with key terms and definitions. See, there's a lot of key terms throughout the closing process, buying process, selling process. A lot of the terminology is very confusing. It's very hard to get an understanding if you're not familiar speaking the language. So today we're going to do a deep dive into some of my favorite key terms, what they use and how they use them. Working with real estate agents is not only a document that your typical buyer or the seller needs to sign, but it's also a documentation that is going to explain to you exactly what type of agent is representing you and what are our responsibilities throughout your transaction. Okay, so we have your typical seller's agent, we have your buyer's agent, we have a dual agent, and a designated dual agent. Okay, so your seller agent is exactly what it sounds like. I am a seller agent. Not only am I responsible for listing your property, but I'm also responsible for putting together a whole presentation. I'm responsible for gathering every single detail about the property and compiling it, putting it together before we market it to the public. A buyer's agent is exactly what it sounds like. I am an agent that's going to represent you to make sure that we're going into the negotiation very strong. Most importantly, finding the dream for you. Dual agent. Now this dual agent is typically a little confusing, okay? So when you have a firm, obviously, and you have a dual agent is basically an agent that represents both sides of the transaction. Now the good thing about a dual agent is everything is in-house when it comes to all the paperwork being handled and everything of such. So everything is enclosed. That's really smooth process. The bad thing about dual agent, or I should say con, would be that I typically can't represent you. So I cannot handle the negotiations. There is no back and forth conversation about what would I do, what do I think, where should you be as far as number wise, any of that. I have to completely place Switzerland in between the transaction. Now, designated dual agency is a little bit better because now we have one firm still, and now we have two agents that represent that one firm. So I have my best friend who may be representing the seller side, and of course, obviously, I'll be representing the buyer side, and now we can actually go into negotiations, and the paperwork is still handled in-house. Now, this has to be designated. This is not something that you get to choose. This is not something that I get to choose. It has to be designated from the firm. Due diligence fee. Due diligence fee is just a fee that you give to the seller, stating that, hey, this is a good faith payment, stating that I want you to take your house off the market and I am serious about buying this house. That's a due diligence fee. We have a process that we love to be under, and that is called the due diligence process. And within this due diligence process, this is just typically a time that we have together to do the thorough research of the property. We're going to do our title search. We're going to acquire title insurance. We're going to look and see if we need a survey. We're going to have the appraisal done, which is going to be ordered from the bank. Everything that we need to do in regards to this property to gain a better understanding that's beneath the hardwood floors, the carpets, the walls, everything. We're going to do that within the due diligence process. We're going to do this specific thing, which is called a title search, and we're going to inquire title insurance. So what exactly is title? Title is ownership. It's a certificate of paper saying that we own this property. Okay? So as we're doing the title search, what exactly are we looking for is, am I buying the property directly from you, or where is the property coming from directly, right? Are there any liens that's attached to the property that we're not aware of, familiar with, of any such? We want to make sure that we are protected as we transfer title, okay? And title insurance. Title insurance helps us and it protects us on the back end. So once the property is closed, the buyer now, of course, obviously they have purchased the title insurance with having the title search. Now we're saying that there's nothing from the past, from the time that I bought this property, can now come back and haunt me, such as IRS liens, mechanics liens, anything of such that may be dealing with anybody else can now not come back and attack. So within our due diligence process, I will be putting together what we call a CMA, which is a comparative market analysis. Actually, this will already be done before we even enter the due diligence process. But what am I doing with a comparative market analysis is I'm showing you exactly what the property may be worth. I'm showing you exactly what's on the current market in the area. I'm showing you exactly everything that's going on within the geographical location of this property by preparing this CMA. Okay? So a lot of buyers ask a lot of questions about home warranty. Okay? So home warranty is exactly what it sounds like. Anytime that you purchase a warranty for your electronics, or anytime you purchase a warranty for your car, of course, powertrain, all that good stuff, home warranty is exactly the same thing. We want to make sure that everything that we purchase within this house is protected as far as appliances, plumbing, anything electrical of such, right? And so home warranty typically doesn't come with the purchase of a property. It is an actual additional service to you if you would like to have it. So these things can also be negotiated throughout the contract or closing process. Like, hey, seller, hey, my client is interested in a property. We want to know, could you put any money toward the home? So all of these things can be negotiated. Home inspection. So this is also something that we'll be performing throughout the due diligence process. We will hire a home inspector. They will come in to look at the property, to look at the nuts and bolts, everything that's under the hardwood floors, everything that's in the ceiling. They're going to get every single detail of the home. They're going to compress a report that they're going to send to the attorney. They're also going to send it back to the bank as well, and they're going to, of course, give us access to it. And this report, again, is going to break down everything that's going on within the property. Okay? Zoning. So zoning, every property has a certain type of zoning ordinance that it stands on, right? So zoning comes directly from the city. So in some areas, you're going to have some restrictive covenants. So of course, a lot of these things are with like HOA companies, where there's always something that you can do for your property or within your property lines, things like those are zoning ordinances. And typically, if there's a zoning restriction, that'd be more like if we're going to put in a new highway here. The state has to notify everybody within the area, and this is a zoning change that we have to go through. They have to order a zoning ordinance in order to do those things. Easement. What exactly is an easement? An easement is someone borrowing something that you own for a certain amount of time. For an example, that cousin that you have that always parks in your driveway because your driveway is closer to his front door than it is to your front door? Well, that's what an easement is. An easement is ownership that you're giving up for someone else to utilize in order to help their principal, which would be their property. What is a mortgage? Well, mortgage is basically the form of a loan. It's the debt, of course, to you that the bank is going to give you to purchase property. That's what a mortgage is, and you're going to make payments on it until it's further paid off. Now, equity. Equity is the difference between what you owe and what the property's worth. So if the property's worth $250,000 and I owe $200,000 on the same property, I have $50,000 worth of equity. It's a good thing, and you can utilize it. Conventional loan is a loan that is not backed by the federal government agency. You can typically see conventional loans with Bank of America, State Employees Credit Union of North Carolina, True Line Credit Union, any standard bank. Your typical banks, they all have non-federally backed loans. Okay, those are called conventional loans. And with the conventional loan, you typically have a 20% down payment you have to put down. Then we have FHA loans. So an FHA loan is actually backed by the Federal Housing Authority. So it's backed by the government. And typically with an FHA loan, Your typical buyer has a lower credit score. They have a little bit more hoops they have to jump through in order to purchase a home. So the typical down payment for FHA loan is 3.5%. With that 3.5%, that will help you get the same loan that you would get as a conventional for $200,000 or so. So it's the same thing. It's just separate. You just have a little bit more of a smaller down. Now, with an FHA loan, you have mortgage insurance that you also have to purchase with that as well. That's called PMI, private mortgage insurance. And this is insurance, not for you, but this is insurance for the bank, stating that we're not going to lose any money out on this deal. So we want to make sure that we're taken care of in case you default on the home loan. Now, if you default on the home loan, you now face foreclosure, and you have to go through a very lengthy process with foreclosure, and it's not good. Equity. So equity, of course, obviously is the debt in between what you owe, what the property's worth. Okay? But in between that debt and what the property's worth, we have a term called home equity line of credit. Now, with our home equity line of credit, we can utilize this credit to purchase another house, maybe purchase a vehicle, maybe get some things done to the home that we would like to get done. So that's what a home equity line of credit is used for. And what the bank does is they typically readjust the loan every year. So they reevaluate the loan based on the market analysis, based on how much the property may be worth at the time, the taxes, the insurance, everything that's going on. So that with a home equity line of credit, and you can actually utilize it to make money off of it, or you can utilize it to get the work done to the property that you'd like to get done. Adjustable rate mortgage. An adjustable rate mortgage is exactly what it sounds like. It is your mortgage rate, which is going to be adjustable for a certain amount of time. And once that length is reached, they're going to go directly to a fixed loan. Okay? So what is a fixed loan? A fixed means that it's nothing going to happen to your loan. What is escrow? So escrow is a bank. It's a business bank, and it's where the business transactions are being held. So anytime you make your payment for your home, you're making your payment on your home insurance and your taxes and everything. When you make that payment goes into an account called escrow. That escrow amount is held until the payment is actually finalized for the full transaction. That's what an escrow is. It's where the main transaction goes. So as you make your payment goes into an account which is called escrow, and then that's where the final transaction is being held before it fully transaction. It is homeowners association, and with the HOA, this just means that there's certain things that you can do to your property based on the private restriction and covenants that the geographical area might be held against, or typically your subdivision. That is what an HOA is. For all my investors, cash flow is the amount of money that's coming in on a property, and once it has paid for your debt, or all the bills or the utilities or everything for your property, and you have a little extra profit left over, that's what cash flow is. So cash flow is your source of income. Then we have loan to value. Loan to value happens when you refinance a home. When you refinance a home, the bank looks at the value of your home based on the loan that you have on the home. So for your large commercial properties and your bigger businesses, they have this formula that we utilize, which is called your net operating income. It's all the income that comes in the property minus all your expenses, and which gives you that profit margin. That is called your net operating income. That now we're analyzing how much money this business actually makes, which are now factors into which is called a cap rate. So if I ever decide to sell a commercial property, and I know the commercial property brings in a certain amount of money, once I take my the net operating income at one time minus all my expenses. I take my profit and I divide that by the amount of money that I'm actually trying to sell the property for, and then that gives me a cap rate. For all my bigger investors, they would know exactly how to calculate a cap rate. Short sale. So what is a short sale? A short sale is actually the sale of a home against the debt that you may owe, but the sale of the home may not actually recover the debt that is actually owed on the property. So this is you and the bank entering an agreement to sell a property together, and that's what a short sale is. MLS. What is the MLS? MLS is where we place your properties for sale. We're going to compile all the information that we gather as realtors, and we're going to put all that information together, and we're going to put it on a multiple listing service. Now, multiple listing service is connected with some of your major sites like Redfin, Zillow, Trulia, all of these good things, okay? And that's what we use to sell beautiful properties like this.